Good evening. You're watching The Big Question on NDTV Profit. I'm Vikram Oza. Now, IPOs, they've always been India's favorite stock market carnival. You see flashy valuations, you see sky-high hype, and there are millions of investors queuing up for their slice of the next big stock. But now, SEBI is proposing to change the rules of the game. The rules change now could mean big relief for India's biggest listed companies. SEBI is proposing easier rules on minimum public shareholding. And that means they're extending the compliance window from 3 years to 5 years for firms with a market cap of anywhere between 50,000 crore rupees and 1 lakh crore rupees. So in this new roadmap, you get 15% public float within 5 years and 25% within 10 years of listing. The aim seems to be simple. It is to simplify fundraising, to reduce that pressure of large-scale equity dilution when it happens in a rush, which often puts a drag on the share prices. What it could also do is encourage more mega listings in the future. But now the question is, how investor-friendly are these norms? When you scratch the surface, there are chances that you'll see founders smiling a lot wider than small investors. Remember, a mega Reliance Jio listing is in the works, so is an NSE. So for such mega companies, the minimum public float has been cut now to just 2.5%. That's half of what it used to be. The timeline to bring promoters down to 25%, now like I mentioned, that has been stretched as well. It is 5 years for most large firms and up to 10 years for the really big ones. So what does this really mean for investors? Fewer shares on offer could mean inflated valuations. It could also mean tighter supply. And the odds seem to be rising of getting allotment as well. So for promoters, it means more control for a longer period of time. And now as the hype around the urban company IPO shows us, the question seems to be rather timely. And the question is this: do these changes protect the small investor, or do they power the big founders even more? And that is really a big question tonight on NDTV Profit. And to debate it, I have a terrific panel with us on the show. Market expert Ajay Bagga is with us, along with former Executive Director of SEBI, Gupta. Also with us on this debate is Narendra Solanki, the Head of Fundamental Research in Investment Services at Anand, Rathi Shares and Stockbrokers. Great to have you with us, gentlemen. A very good evening. Narendra Solanki, first to you.
Good evening.
SEBI is saying that the new norms make Indian IPOs more attractive to global capital. But from where you are sitting, does lowering this dilution, the kind of requirements for dilution, do they make IPOs riskier, more expensive for small investors?
Yeah, good evening to you, Vikram, and good evening to all the panelists. I think it's a welcome move, and I don't see it as a risk, but if you see largely on a yearly basis, we have a pipeline of around 50,000 to maybe 1 lakh 25,000 crore of IPOs. So in any good year, we cross that 1 lakh mark, and in not so good year, we are hovering at about 50 to 60,000 crore. And now if you see the pending pipeline of the IPOs, which the SEBI has already approved, it hovers at around 1 lakh 60,000 somewhere crore. So that's a huge pipeline, and I think this actually gives market a kind of a breather in terms of absorbing this huge pipeline. So this dilution, this relaxation in the dilution addresses one of these situations. Plus, if you look at another point, especially post-COVID, we have seen a lot of new age and new tech businesses coming up around, and they have not been able to find representations in the listed market space, and a lot of unlisted trading activity has also been happening, which is much riskier and much and also not transparent for the retail investors. So I think it addresses that problem as well, and we can see a lot of unlisted businesses also trying to go for a listing in their early stages.
Right.
So I think it addresses 2-3 critical issues for the market. And one more important thing would be coming out with this is that with the increase in the anchor share also, the long-term investors would be having a much wider hold on the subscription of the IPO, so which reduces the volatility as well post-listing, which generally we see during the early trading days of the listings, wherein we see volatility of more than 10%
Yeah.
for some of the IPOs. So that also addresses the liquidity issues. Now, coming to another factor regarding the participation and riskiness of the retail investors, because the free float would be very low. So I don't think these companies would be able to find any participation in broader market indices so soon. So from that index-based ETF flow perspective, I think it would be they won't be finding any broader participation from that point of view. So only a direct retail participation or a mutual fund bet would be the choice for whoever wants to invest in these kind of stocks.
Right.
So I think this also insulates from that perspective.
So at least 3-4 counts, as you are pointing out, Mr. Solanki, there are those benefits that accrue to the markets at large, whether it's the absorption of really big IPOs or whether you're talking about liquidity. Mr. Gupta, you tell me if you agree with this or not, because there has to be a regulatory intent in the kind of proposals that are coming out of SEBI. Is this about boosting India's competitiveness against global markets, or do you think there is pressure from large corporates who are looking at slightly easier entry with the kind of IPOs that they've got?
Good evening, panelists. I would say the lawmaking is just like Rubik's Cube. You can't solve it in first attempt.
Right.
So every time you make law, the other side will change the color, and so you will not be having a full solution. So every attempt of SEBI will have pros and cons.
Right.
And everybody will say SEBI has succumbed to this pressure or that pressure. So let me assure you, SEBI would not succumb to pressure. SEBI will always go in a balanced way. Now, the issue is when you say the promoters are or founders or something, but it's becoming stronger. Now, I would say any investor would not want a weak promoter, because when you have a weak promoter or weak controller, the risk is much higher.
Okay.
The other issue is this: I don't buy the idea that since many IPOs are in pipeline, so you have to do it, because none of us has got the estimate that how much is the investor sitting on the money, how much they will bring to the market. So we don't know. So we say that capacity is 1 lakh crore or 2 lakh crore. We could be absolutely wrong. It could be 10 lakhs crore, or it could be 50,000 crore. We don't know.
Sure.
The third issue is that the problem arises when IPOs are bunched. So if a big IPO is bunched with a 5 or 6 small IPO,
yes,
then it could be a pressure that the bigger IPO, because of the bigger name, will overshadow the smaller IPO.
Exactly.
The third point is this: ultimately, whom we are protecting.
Mm-hmm.
The idea of regulator is to protect the market. Right. And who are the participants in the market? It's my investors, brokers, promoters, everybody.
Okay.
Now, what happens if you bring lot of supply in the market? Say, for example, today tomatoes are selling for 50 rupees a kg. Suppose tomorrow in the market 10 tons of tomatoes are dumped. It will not sell for 40, 50 rupees a kg.
Right.
So the issue is very simply, if you do more supply, the price, and the promoters, why they should, if they value the thing at X amount, why? Because of the supply issue, they should do it. So ultimately, idea is that the liquidity should be there. And liquidity does not come by the percentage. Liquidity comes by the number.
But doesn't it make price discovery that much more difficult, Mr. Gupta?
Yeah. So then I'm saying it will be fair price discovery. The only issue that remains is that what are the consequential effect of that thing? One of the big consequential impact is that you have a section 100 or 106 in the Companies Act, which is minority protection, which says the minimum 10% of the shareholders are required to approach any court of law or any regulator.
Right.
Now, when you have only 5% stock in the listed space, then where the hell you find the 10%? So similarly, we will have to look into all other related laws which are impacted by this and take care of that.
Right.
It can't happen that you settle the 1 lakh but you don't settle the other leg. You have to make the both leg
So
equal,
you need
otherwise
to
you will not.
create that balance. When you're creating new norms, you need to create that balance as well. It's an important piece. All the points that you're putting out there, Mr. Gupta, are well taken. Mr. Bagga, I want to ask you if you agree with what is being spelled out. For retail investors who are watching tonight, I'm wondering whether the new norms mean fewer allotments, whether it could mean higher pricing where valuations, there are question marks, and maybe a rougher deal at IPO time for investors in general when you have these supply kind of constraints, if you can call them that.
Yeah, it's a difficult one. As Gupta ji mentioned, there are pros and cons, and Mr. Solanki laid out very clearly the pros. I would say what worries me in this scenario. One, I mean, it's going towards the US market where, irrespective of the market cap, the regulator only lays down that minimum this much should be the public float in terms of dollar billions. And they are quite okay with, after that, whatever the companies are doing. If you look at Asian countries, mostly they have transitioned, moved towards 25%. The EU prefers 25%. Germans give 10% in some scenarios. I have handled issues like that. But mostly they would prefer 25% free float. Your market does not get ranked very highly if you don't have too much free float. That is another issue which we have faced in India. Your MSCI rankings, ratings won't come.
Right.
Second, what will happen with something like this? For 10 years, there will always be the sword of dilution sitting on customers' heads. So whenever the promoter sells, it's only in India that an OFS comes in and the stocks go up. Otherwise, it's a red light for anybody, a red light marker for markets if the promoter is selling. Here, promoters will keep selling for 10 years and substantial amounts because fully they will also be growing at 15% per annum. So imagine over 10 years to sell out another 22.5%. At compounding at 15%, how much of supply that will bring. So I'm not sure this is the best idea. I don't know about the governance, what Gupta ji mentioned already in terms of minority shareholder protection, Vikram. I think those are some of the markers that stand out in this proposed legislation.
And also, I wanted to bring up that point that Mr. Solanki did from a startup ecosystem as well, Mr. Bagga. Do you see this as a genuine enabler of entrepreneurship, or do you think these rules are more about pleasing the unicorns rather than supporting the broader startup ecosystem? Because we are at that pivotal point, aren't we?
Yeah, the startups should not be waiting for 5 lakh crore kind of valuations, $50 billion valuations and then coming public. What I would think. Mostly we should have a good SME exchange which is doing fair price, and they come under the $50,000 or 50,000 crores or 1 lakh crore kind of at most, at a stretch. These are the mega corps which will be hived off from companies or government companies which are legacy companies coming in. You won't have many new companies which have trundled along and stayed private. And then at 5 lakh crore, they decide that I want to enter the market. So that's why the media is talking that is it appeasement of certain segments or certain corporates that is happening through this.
In fact,
that definitely comes up.
Indeed. So, Mr. Solanki, on that very point, I mean, we've seen massive IPO oversubscriptions in recent times. Urban Company comes to mind and Ola Electric in the past. I'm just wondering if these lower floats risk creating some kind of artificial scarcity effect that could possibly distort valuations. Do you see that happening?
See, as far as oversubscription is concerned, definitely that we can continue to see. And oversubscription generally hinges on the leverage effect, which we generally see in the markets during the IPOs, wherein a lot of people actually take a certain amount of leverage and try to get their chances of allotment higher because by using that. So that is that is one of the risks that we may face in the current situation where the supply is lower. But I think we have to see when a large company which is coming out with a IPO of say around 15 to 20,000 crore. So I think I don't think that there we can see that amount of lower allotments coming in that kind of an issue.
Fair enough. But Mr. Gupta, on that point of governance safeguards that Mr. Bagga was alluding to, these new rules, whether they are the lock-in rules, whether they are the disclosures, the governance safeguards, you think they balance out the risks that may be there for small investors, or do you think that SEBI has tilted the scales a little bit?
See, let us understand what are the sources of risk in a listed stock. In a listed stock, the biggest risk is market manipulation. The manipulation is possible only when the floating stock is low. Here it is a question, we are saying the floating stock is so big that it is not possible for a company to make the issue. So number of shares that are there are very high. What we have to guard is this: the number of shares should not be distributed into 10 or 20 people that they have whatever is in the public domain, they command 90% of that share and they keep on manipulating. But even if they are doing it, SEBI has got sufficient system to catch that. The risk comes from that. The other risk comes is because if you have got 95% holding, then the special resolution that is passed in the company with a 75% majority loses its relevance. So SEBI will have to work out in such a manner that if you are doing the public float, so whatever is public float should become equal to more than 25%. And the voting power of promoters or founders, whatever it may be, should be balanced in such a way that 3:1 ratio is maintained.
Right.
So that special resolution can be defeated.
So you're saying only if that happens, then this is likely to work in a balanced kind of way. Mr. Bagga, what do you make of that? Often we hear founders arguing that they should not be forced to give up too much equity too soon. But you think retail investors are paying for that kind of comfort that founders are likely to enjoy now?
Look at global companies, there are no promoters. Or within India also, some of the largest institutions, there are no promoters. And they are very well run. They are board-run companies with management appointed by boards. So, this is something that Indian promoters always do, that they hang on to as much as they can for as long as they can. They want the listing. They want to get the currency from the listing. But then they don't want to dilute down, and they will take the regulator to court. They will cite COVID and this and that happening. That makes the retail investor ultimately lose out, because unless your free float is there, that stock will not get into global indices, will not get that ranking. And as market also, we suffer then, because we are very low on free float with respect to our size. We are a top 5 market, but we don't have the free float to really justify. And that's why we don't get our rankings in the global rankings. That's what promoters have to understand, that it's not that either you then stay private, but if you want to come public, you have to have enough free float. And as Mr. Solanki was mentioning, the institutions will not be able to come in because there's a very clear impact cost criteria.
Correct.
And if you have so little of free float, and then you actually see the actual free float, as Mr. Gupta was mentioning, the stock gets cornered by, known hands and informed hands. And then there is hardly any, free float available for mutual funds. The impact cost is too high. The fund manager will not get compliance approvals.
Mr. Gupta wants to come in on that. Mr. Gupta, you were saying?
See, again, I am saying the free float we define in terms of percentage or number of shares.
Which is already happening.
I always say percentage of shares have no meaning for me. Because if you have got a company which has a 10 crore market cap and is 25% or 30% free float, it's 1,000 into 30, 300 crore. If you have a company which has a 1 lakh market cap and it has a 5% free float, it has a 5,000 crore.
Correct.
So the issue is the balance has to be what are the number of shares which are in the market, what is their value, and how they are concentrated.
Right.
Now, say, for example, if 5% is there, look at the question of LIC.
Right.
LIC is only 5% or less than 5%.
Yes.
And it is concentrated with institutions.
Right.
So
Mr. Bagga
there's
wants
a
to
problem.
counter on that. Mr. Bagga?
No, I agree with that, sir. But why have regulators globally put a 25% free float? There is science behind it. There is thinking behind it. Irrespective of the size, they prefer a 25%. That is the norm. If you look at the top 30, 40 exchanges around the world. So it is a norm that has come in. It's not meant because, see, I'll tell you very clearly, if I'm a big fund manager and I want a sizable position, and I want to put in $200 million. I can't put in. That it becomes as simple as that. While if it's a 10 lakh crore share and it has a 40% free float, my impact cost goes down. I will not get compliance clearance only. That 2.5 will become an issue. It's not that simple, sir. And that's why everybody is going to 25%.
So 25% as a global standard, you're saying that what works globally perhaps may not be working over here. Mr. Gupta, what are you saying to that?
I'm again saying, Mr. Bagga has said that in America there is no concept of promoter. So everything is free float. In India, the issue is, again, I'm saying, when a mutual fund or LIC or insurance company invest, they invest on the amount. Nobody says that I want to have a 5% pie in this company or 2% pie in this company. Now, my amount is so big. Say, for example, if a company which is a 10 lakh crore market cap,
yes,
I don't think LIC would want to own 10% of that because it will be 1 lakh crore.
Right.
So LIC will still want to have 10,000 crore, 5,000 crore. So again, I'm saying it is the number of shares which are available and the market cap. It has nothing to do with percentage. The only thing to do with percentage is ensuring that special resolution passage is possible only with the support of public. Similarly, related party issue, similarly, protection of minority. We got to take care of all those issues from where the governance can be diluted. And if you handle that, there is no problem.
Mr. Solanki, in all of this, what do you say? Retail investors, should they be more cautious with IPOs after these rule changes come in, whenever they do? Or is this still a growth story that they must participate in? What's your take overall?
See, instead of being cautious, I think we should take it positively. And as far as IPOs are concerned, it is more of a valuation-driven investing exercise. So it doesn't matter what kind of a dilution which is happening, as far as it is happening at a decent valuation and there is ample growth opportunity. So with that happening, I think most of the companies IPOs would sail through. I do concur with one point Mr. Gupta made was regarding the protection of minority rights and how the MCA's circulars, etc., regarding the special resolution that would happen. So that is one of the area wherein I think a regulator must look at it. And I think apart from that, it's a exercise in progress. And I think as and when we develop experience and learning post this on norms, so then only I think regulator would be in a position to tweak it further if it sees so.
Right, fair enough.
Deciding on, yeah.
But Mr. Bagga, do you see these norms, since you're citing global standards as well, do you see the norms that are being proposed over here making India that much more attractive as an investment destination for global institutional investors who actually prefer larger, more liquid companies?
Yeah, but see, I never second guess the regulator, so they must have done a lot of data crunching and arrived at right now an optimum solution.
Okay.
I think it's a process, so regulation also evolves with time. This is solving for maybe some large IPOs, or it is solving for the present situation. Again, I'm saying if we have to reach the top 3 stock exchanges in the world to get our massive allocations on MSCI, FTSE kind of indices, we need free float.
Okay.
So that way, this is going to have a sword hanging on your stocks. Those promoters will need to keep on, and they will petition the regulator on various things. We have seen that on banks.
Yes.
So many bankers never gave up their stake. They would file cases even against RBI.
Very true.
So will continue to happen. Promoters, if it's doing very well, they will not let go that easily. That is the concern. So if you get them off running to start with, because there are not that many cases of 5 lakh crore companies coming. LIC is one case.
Hyundai, I mean, there will be quite a few, perhaps in times to come. But yes, as far as numbers go, you are going to have fewer over there. But Mr. Gupta had another point to make, and perhaps the last point, Mr. Gupta, because these IPO rule changes, do you see them widening the gap between those elite IPOs, the big unicorns, and the smaller companies? Or do you think that both can benefit from this kind of new framework, although you say that it has to be work in motion?
First of all, I would say, I do not believe or I do not want to follow what happens anywhere else. We are capable enough to become leaders in the world. And I give you an example that credit rating agencies were regulated in India first than anywhere else. So we can always show the world the path. That is one. The second thing is this, saying that it will become a market for elite listing or a smaller company will lose out is not a case. Every company which is worth it will get investor attention.
Okay.
If not at the IPO time, subsequent to IPO, or if at the IPO time they get attention, but after IPO they may lose attention, everything will happen. It's a stock market is a place where you got to take risk. If you say that please remove the risk from the stock market, I would say please get removed from the stock market.
Oh, Lord.
Risk cannot be removed.
All right, fair it is. I mean, SEBI's new IPO norms, you can't take away. I mean, there is a bold step that is being taken. Perhaps it will deepen India's capital markets. It could be a subtle tilt towards keeping founders in the driver's seat for a little longer. But for investors, the takeaway is clear. Less equity on offer means that investors will have to be sharper in assessing valuations, judging governance before they actually jump onto the IPO bandwagon. I want to thank my panel for joining us with their sharp takes tonight. For all of us who are watching tonight, remember every IPO is sold with a story, but it's the investors' money on the line. And the real question is, are we buying growth or are we buying into hype? That's something we must always answer. I'm Vikram Oza. This is The Big Question. Stay with us on NDTV Profit.